You have money in a traditional IRA, a SEP IRA, or a simple IRA, the IRS regards all that as just IRA. It doesn't matter how many accounts you have, where they're located, whether or not it's all in one of those or spread across all three. That to the IRS is IRA. And if you do a Roth conversion during the course of the year and you wind up with anything other than a zero balance in those IRA accounts, you're going to wind up subject to the pro-rata rule, which means that some of that's just going to be taxed as ordinary income.
Welcome to the Physician Family Financial Advisors podcast, where physician moms and dads like you can turn today's worries about taxes and investing into all the money you need for retirement and college.
Hello, physician moms and dads. I'm Nate Reineke, certified financial planner and primary advisor.
And I'm Ben Utley, also a CFP and the service team leader here at Physician Family. Today, we're going to just dive right into another bout of listener questions. Nate, what's on deck first?
Yes, we have a family medicine doctor in Alaska.
Is it baked Alaska or cold
Ben.
Alaska?
Yeah, I don't know.
You know what? I'll tell you a quick story. I flew Alaskan Airlines one time, and the person who was steward, whatever you call them these days, was like, just let me know if there's anything I can get you. And I said, just free beer. And you know what? They brought me a free beer, and not only that was a microbrew.
Nice.
It's my Alaska story.
Cool. All right. This doctor wants to know, what is bond discounting and how does it work? Okay.
All right. So I'm our local bond ghoul.
Yes. Let's take it back a few steps here. We jumped right in.
What's a bond?
Yeah. What's a bond?
What's a bond? A bond is it's nothing but a loan. Okay.
Yeah.
So if a friend borrows from you, you call it a loan or an IOU. If a government, a corporation, one of those borrows from you, then we call it a bond. Okay. And so a bond happens when a school district or Apple or somebody like that needs money, and as if Apple would ever need money, they come to you and they're like, hey, I want to borrow, let's make a bond. And that's the third grade version of it. And you buy that bond. And when the bond matures, they guarantee that you get your money back. Sometimes they welch. It's called default. In the meantime, you get interest, right? So no big deal. Works like any other loan. Okay. So that's the basics of a bond. Where do I go from there?
So you say you get your money back. And so we're talking about the value of a bond, right? It's like the par value. I think that's what it's called, right, Ben?
Yeah.
You're the bond guy. So this is just like the face value of a bond. And I always think of this as like, you get your grandparents may have given you like these paper bonds you have in the bottom of your sock drawer, kind of like a dollar bill. The top of that paper bond says like $1,000. It's the face value of a bond. So when someone's buying this from you, let's say you needed to sell it, sometimes they don't buy it for $1,000.
Correct.
And this is called discounting, right?
Discounting, yeah. So every bond has what's known as a coupon rate, which is that is the rate that's printed on the face of the bond. Let's say it's 5%, right? And bonds are usually issued in denominations of $10,000. They trade in bigger denominations than that, but let's say $10,000. Okay. So you go out there and you buy a brand new bond, which is called an at-issue bond. Okay, so you're buying it just as it's floated onto Wall Street. Okay, so you put $10,000 in this bond at 5%. Let's say it's for a year. Okay, so over the course of that time, you are expecting $500 in interest. Okay, now let's say that you're cruising along and interest rates rise from 5% to 10%, just to make the math easier. Seldom do they rise that fast. Okay, now let's say you also want to sell that bond at the same time. Well, so if I'm a brand new bond buyer, I can look at your bond, which yields 5%, or I can look in the market and I can get 10%. Okay, so I would never ever buy your bond if you're selling it for $10,000. But if you were selling it for a lot less than $10,000, such that the yield on it wound up being 10%, then I'd be like, sure, I'll buy your bond. But you're going to have to discount that bond. You're going to have to reduce the purchase price that you want, right? You can't reduce the face value because that's printed on the bond, but the market value of the bond has gone down because interest rates go up. Okay. So the listener is asking a question like, what is bond discounting? As if, as if you could discount a bond or there's a strategy about bond discounting. There's not. This is merely a market mechanic that is pricing down the value of an asset because there are better assets available out there. I'm not sure how many listeners are familiar with this concept, but when interest rates rise, bond values drop because there are better interest rates available on newer issues, right? By the corollary, from the 80s all the way through the early 2000s, interest rates dropped over that time period and bond prices rose over that time period. So there's this inverse correlation between bond prices and interest rates. So when interest rates rise, bond prices fall. If you buy one of those bonds that is below face value, that's called discounting. And assuming that the company who issues the bond does what they're supposed to do, which is to say that they repay the bond in full, then you would actually get a capital gain on that. So let's say you buy a $10,000 bond for $9,500. When that bond comes due, you're going to actually get $10,000. So that means that you're going to get $500 worth of capital gain in there. So to make things more interesting, there are some bonds called OIDs, or original issue discount bonds. And so they're made available at a discount, and they mature at face value. A common example of this is T-bills, Treasury bills. U.S. Treasury bills are issued at a discount and mature at their face or par value.
Okay. So that answers the question, but I wanted to kind of bring this into something that's pretty relevant today. I see a lot of physicians, or they'll ask me about sticking their emergency fund in some form of bond. And maybe we could talk about that for a second, and kind of where you could be crossing the line of maybe inappropriate.
Yeah.
Which bonds are appropriate for emergency funds and which aren't.
Yeah. So there are a couple of factors about bonds. One is duration or maturity. It's how long the bond goes. And that gives you some idea about how volatile it will be as interest rates change. The other one is credit quality, or likelihood that it will be repaid. So you have junk bonds that are less likely to be repaid. You have U.S. Treasury and government debt, which is the most likely to be repaid. You have corporate debt, which can be rated somewhere in between. So I don't see a problem putting emergency fund into ultra short bonds, which are bonds with less than a 1-year maturity and of high credit quality. So this would be AAA, AA, government securities, that kind of thing. It's not a bad idea. However, buying bonds themselves, like buying individual stocks, buying individual bonds is a pain in the butt. You have to have a brokerage account. You have to go buy these, one at a time. It's like shopping for groceries. It is so much easier to pick up an exchange traded fund that invests in those bonds and pay the 0.03% to get it, which is next to nothing, right? And then you have liquidity. So you can trade that exchange traded fund all throughout the day. You don't have to worry about things being traded dealer to dealer, which is bonds are. It's just so much easier. It's way easier to trade them.
It's easier, but there, something you just said, the liquidity is really important for an emergency fund.
Absolutely.
Some people are just looking at this rate, the rate that they're going to get, and they're not kind of taking into account the goal of an emergency fund. So liquidity is a big goal. Another one is if you're not buying those ultra short-term bonds, which, circling back to something you just said, is essentially bonds that mature really fast and you get the full face value back. So if the interest rates go up and down, you don't really care because they're just going to mature and you're going to get the full value back. So if you buy longer term bonds and you need the money, if interest rates went up, you're not going to get all your money back.
Yeah.
Right.
That's true.
So that's what to look at there. And I get that question quite often. So hopefully that's helpful.
ETFs are just it's just a slam dunk way to handle this. I mean, gosh, I don't know. I'm trying to think of an analogy and I can't come up with one. Yeah, that's how I tackle it if I was doing that. But before I do that, I look at something that's FDIC insured for an emergency fund. Unless you don't ever think you're going to tap this emergency fund, in which case you could put it in bonds. It makes sense. But that's how bonds work. And bonds belong in almost all portfolios, even for aggressive investors, maybe 10%.
Okay. Next question from a hospitalist in San Diego, California, and an academic interventional radiologist in San Francisco. And I got these questions.
Are we getting a twofer here? We're getting two. Two docs in one?
No, this is two separate families.
Same question, two families.
Yeah. So I'm like, I have
okay.
to.
Wow.
So
This is the first time in Physician Family Financial Advisors podcast history.
That's right. So they're both asking me, how do I buy a house in California and stay on track?
Or retirement college, right?
For retirement in college. Yes. So every once in a while, I will get these brave souls who attempt to buy a house in San Diego or San Francisco, and they still want to stay on track for college and retirement. And they want to know, how do I do it? So the San Diego doc, they have a story. They saved up $1 million in cash. $1 million in cash because they have this big goal of buying a $3 to $4 million house. And, the combined income is maybe 650, 700. So they're looking at a $3 million mortgage. They make 700. But the issue is that in order to get that $1 million, they're now in their early 40s. So they don't have a ton saved for retirement. Both of these families they have a decision to make. They can they have to choose which prize they want. Do you want a really comfortable retirement, or do you want a pretty lean retirement in a great house in San Diego, California, or San Francisco?
Do you want to pay the sun tax?
Yes, it's just the sun tax, and it's expensive.
Yeah.
And I think physicians look at that and they think, I'm a physician. I should be able to afford the house I want in the city I want. The people who can really afford this are like the tech guys in San Francisco.
But this seems like a rather arbitrary and false choice. I mean, having to put $1 million in a $3 or $4 million house. I mean, what happened to the 5% down doctor loan? Like, where is that in this?
Well, they didn't have to. That's just what they did. And yeah, I don't know. That's when they showed up on my door.
I'm sure some people tear the wings off of flies, but this is self-flagellation. It's terrible.
Well, there is some merit to it, which is if you put 5% down on a house, their mortgage payment is just absolutely absurd. And so, looking back, if they would have been investing over the last 10 years instead of saving up cash, they would have done pretty well. But they are where they are now, and that they're making this choice between a really nice house, which is their goal, and saving for college and retirement. And the plan made it very obvious that this is a choice. You can't do both.
What's killing me here, Nate, is that equities have almost doubled in that decade.
Yeah.
Right? Not that, hard to say because 10 years is a long time horizon, but, if there's a house at the end of it, but you think maybe a portion of that in stocks, a portion of that in bonds or something. And they could have had the house back then, right? With 5 or 10% down. And we know what home prices have done. They've appreciated. So I don't know, just sitting on cash for a decade, a lot of that decade was 0% interest rates. It's terrible.
Yeah. Yeah. So
this is what kills me. This is what absolutely killed me. They could have paid for our advice with a tiny fraction of the money that they've wasted and been so much better off,
Yeah. So that's tough. And then the other family, the non San Francisco family, San Diego family, they're waiting for kind of everything to line up. They needed to move. They needed a down payment. They didn't make as much. And I think they're going to successfully do it. They prepared with our advice and have been saving along the way. But if you're in a position where you're paying the sun tax and you really want that big house versus retirement in college, my advice is don't pay the sun tax, or don't buy the $3 million, $4 million house. A lot of times what happens is people want to move to these big cities and they want a house that's comparable to the house that they're paying for South Carolina. And that's not the prize. The prize isn't the house in these states. The prize is the beach. So buy a worse house.
I'll tell you one better, Missouri.
Mm-hmm.
Missouri's got affordable home prices, right?
Yeah.
But the reason people do this is because they want to live near family. Mom and dad live there, brothers and sisters live there. It makes total sense to me. But there are lower cost areas in California, and I don't know, it's tough. But there are jobs that physicians can work at a distance. So there's lots of room for flexibility here. But you have to carefully push back on all the assumptions and all the constraints.
Yes. So, the answer, I think the reason I wanted to include this question is that physicians feel like they should be able to do this. What are they doing wrong to where they can't go buy a house anywhere they want?
Yeah.
You're not doing anything wrong. Houses in San Diego, San Francisco, New York are very expensive. And I know physicians that don't buy.
Yeah, you're either competing with old money or tech billionaires. You can't compete with those guys as a physician. Not anymore,
That's right. Yeah.
Yeah.
All right. Pediatrician in Washington. My employer makes discretionary non-elective contributions to my 401k at work. I read that these non-elective employer contributions may be increased, decreased, or eliminated at any time. I'm not sure what to make of the can be eliminated at any time piece in terms of our financial plan. Is this normal? So, the eliminated at any time piece clause is normal.
Yeah.
It's just provides flexibility under bad business conditions for an employer. In fact, I've seen it so many times that when I'm writing plans, I don't put in some measure of conservatism. We just say, you get it, because most of the time you will. But the deeper underlying piece of this question is, I think a lot of folks, when they're writing their plans, they just assume things are not going to change.
Mm-hmm.
Like anytime there's a chance that something will change, it's like, what are we going to do about this? Well, I got news for you. Yes, I got news for you. Things are going to change. In fact, there's going to be 10 changes before your employer decides not to give you your 4% into your 401k.
Yeah.
Right? So, you update the plan just like your life gets updated. Your financial plan, your financial journey, it's like a living story. That's your life.
Yeah.
It's not a static spreadsheet, and there's going to be plot twists.
And just because you write it down doesn't make it fairy tale.
That's right.
So here's how I would summarize a lot of this. When they say they can be increased, decreased, or eliminated, that is the definition, just discretionary.
Right.
They're just defining discretionary. That's all there is to it,
Mm-hmm.
And that's kind of like life. Things can be increased, decreased, or eliminated. And so life, you just got to roll with the punches.
That's right.
But it's good to have a plan before you get in the ring.
That's right. And, once you have a plan, you take away 4% one place, you know exactly where to make up for it.
Yeah, that's not going to make or break a plan,
No. All right. I got a listener question by email, which we really appreciate. You can send them to us. Active duty orthopedic surgeon. I currently max out my Roth IRA and spousal Roth IRA annually, but I anticipate needing to perform a backdoor Roth in the future due to expected income increases. My concern is that I already have money in my traditional IRA at Vanguard. This money was a rollover from 401ks. The amount is $64,000 and it's actively invested. I rolled it over because I prefer the investment options at Vanguard. Is it correct that in order to avoid the pro-rata rule when performing a backdoor Roth IRA conversion, the traditional IRA needs to have a zero balance? If so, what should I do with the traditional IRA money now to plan for my eventual need for a backdoor Roth?
Yes, it's correct.
That is correct.
If you have money in a traditional IRA, a SEP IRA, or a simple IRA, the IRS regards all that as just IRA. It doesn't matter how many accounts you have, where they're located, whether or not it's all in one of those or spread across all three. That's the IRS's IRA. And if you do a Roth conversion during the course of the year and you wind up with anything other than a zero balance in those IRA accounts, you're going to wind up subject to the pro-rata rule, which means that some of that's just going to be taxed as ordinary income. So, the listener's like, so first, true. And second, what do I do about it? Okay, so what you do about it is, if you're active military, you've got the first thrift savings plan, which is basically your 401k. So you could take that traditional IRA and roll it back into the first thrift savings plan, which their investment options there are not unlike Vanguard. They're index funds, and they're great index funds and very super low cost. So yeah, that's a good option. But they might want to do a little tax planning, because if they're able to make Roth contributions right now, that means that they're probably in a position where they could do a Roth conversion on a taxable basis and wind up with a whole bunch of money in their Roth to grow tax-free forever. So you just have to do a little analysis to see whether or not it makes sense to convert that traditional IRA and pay taxes today and have that money grow tax-free forever, or if it would make more sense to roll it into the first TSP and then continue doing the backdoor Roth contributions.
Yeah. So I'll put, right? Because if it's worth it putting money in the Roth IRA in the first place, isn't it worth it to convert some right now?
Yeah, might
right?
be. I did this way early on before the business really took off. I had some traditional IRAs, and I just converted them, and geez, those are 6-figure accounts now because they've just been growing Roth IRA tax-free this whole time. It was a good, I guess, a good investment, if you will, back then to make that conversion. Right. But I would not recommend this for somebody who's, mid-stage in their career and they're earning, the mid 6 figures, that kind of thing. That's a no-no at that time.
Yes.
No, I said a no-no. You said yes. I say no-no. And with that said, we have no more time today and no more questions. So if you have questions, feel free to reach out to us. It's, what is it, Nate? podcast@physicianfamily.com. You can visit us at physicianfamily.com. We are accepting clients. If you have buddies and friends and you're looking for someone who is ethical, that will treat them right, and hook them up with a podcast. Hopefully they'll give us a ring. Until next time, remember, you're not just making a living, you're making a life.
Thank you for listening to the Physician Family Financial Advisors podcast. Are you getting all the tax breaks you really deserve? To find out, get your copy of the Overtaxed Doctor's Retirement Investing Checklist, available at physicianfamily.com/go. This show is for educational purposes only and is not personalized advice. Consult your tax advisor before taking action. All investments involve risk of loss. Past performance is no guarantee of future results. Read show notes for full disclosure.